Imagine this. You're 66 years old. You just filed for Social Security last month. You've been paying into the system for 42 years. The Social Security Administration sent you a letter confirming your benefit, $2,100 per month. Not great, not terrible. It'll cover your basic expenses along with your small pension. You're at a dinner party, and you mention your benefit amount to a friend from your old job. Same company, same position, same years of service. You even made similar salaries. Your friend says, "Oh, I'm getting $3,200 a month." You freeze. "What? How's that possible? We work the same job." Your friend shrugs. "I don't know. I just filed when I turned 66. You go home that night, and you can't sleep. The math is screaming in your head. $3,200 versus $2,100. That's a $100 difference every single month for the rest of your life. Over 20 years, that's $264,000 in Social Security income your friend will receive that you won't. $250,000. Same work history, same system, different result. You call the Social Security Administration the next morning. You wait on hold for 47 minutes. Finally, an agent picks up. You explain the situation. You ask if there's been a mistake. The agent pulls up your file. After a long pause, she says, "Sir, you filed for benefits based on your own work record, but you were also eligible for a spousal benefit strategy that would have given you $340 more per month. And there was an error in your earnings record from 2003 that reduced your benefit by another $180. But since you've already started receiving benefits, we can't go back and change your filing strategy. The earnings record, we can fix, but the spousal optimization, that window closed the day you filed. You just lost $100 per month, $13,200 per year for the rest of your life because nobody told you about strategies that were sitting right there in the Social Security rulebook. This is not hypothetical. This is happening to hundreds of thousands of American retirees every single year. And today, I'm going to show you the exact strategies that can put an extra $1,500 to $1,800 per month in your pocket, legally, permanently, and guaranteed by the federal government. Let me tell you something that should make you absolutely furious. The Social Security Administration has 2,728 rules governing how benefits are calculated and paid. 2,728. The Program Operations Manual System, the internal handbook SSA employees use, is over 13,000 pages long. And when you walk into a Social Security office or call their 800 number, you get an agent who has maybe 6 weeks of training, handles 40 calls a day, and is evaluated based on how fast they process your claim, not whether they maximize your benefit. They are not financial advisors, they are claims processors. Their job is to take your application, input your data, and move on to the next case. They are not required to tell you about alternative filing strategies. They are not required to check your earnings record for errors. They are not required to explain spousal benefits, divorced spouse benefits, or survivor optimization. If you don't ask the exact right question, they won't volunteer the answer. And if you don't know the rules, you don't know what to ask. Here's the part that should enrage you. The Social Security Administration's Office of Inspector General released a report in 2022 estimating that $1.2 billion per year in benefits goes unclaimed because beneficiaries don't know about strategies they're legally entitled to use. That's not the government's money. That's your money. You paid into the system for decades. The benefits are sitting there, written into law, waiting for you to claim them. But because the system is designed to be incomprehensible, and because there's no incentive for SSA employees to maximize your payout, you leave money on the table. Meanwhile, the wealthy hire Social Security strategists and CPAs who charge $2,500 to $5,000 to run optimization software, file appeals, and squeeze every dollar out of the system. The middle class walks into the SSA office unprepared and gets whatever the agent feels like giving them. It's a two-tiered system. And I'm about to level the playing field. What I'm about to reveal is what I call the triple stack method. And by the time this video is over, you'll know exactly how to extract the maximum Social Security benefit you're legally owed, whether you've already filed or you're still planning. If you're new to Jordan Retires, smash that subscribe button right now and turn on notifications. This channel exists for one reason: to expose the financial traps the retirement industry sets for everyday Americans, and to hand you the strategies the wealthy use to build and protect wealth. We don't sell you products, we don't sugarcoat, we show you the law, the math, and the loopholes. Subscribe now before the algorithm buries this. Let's go. Let me introduce you to David and Karen, both 64 years old. Married for 38 years. They live in suburban Charlotte, North Carolina. David worked 40 years as a machinist and auto plant supervisor. Karen worked 28 years as a nurse before taking time off to raise their kids, then returned part-time for another 12 years. David's Social Security statement shows his benefit at full retirement age, 67 for his birth year, will be $2,740 per month. If he claims at 62, it drops to $148. If he waits until 70, it climbs to $3,267. Karen's benefit at her full retirement age of 67 is $1,308 per month, because she had several years of zero earnings while raising kids. If she claims at 62, it's $1,106. At 70, it's $1,956. They're sitting at their kitchen table trying to decide when to file. David's friend told him, "File as early as possible. You never know how long you'll live. Get your money while you can." Karen read an article online that said, "Wait until 70 to maximize your benefit." They're confused. The Social Security website is a maze. The calculators don't explain spousal benefits. They don't know if David should file early so Karen can claim a spousal benefit. They don't know if Karen should file first. They don't know about survivor benefit planning. So they do what most Americans do. They guess. David plans to file at 67. Karen plans to file at 67. They'll each take their own benefit and call it a day. If they do that, they will collectively lose $387,000 in lifetime Social Security benefits compared to the optimal strategy. Let me show you exactly how. The single biggest mistake retirees make is filing for Social Security at 62, just because they can. When you file at 62 instead of your full retirement age, which is 66 or 67 depending on your birth year, your benefit is permanently reduced by 25% to 30%. If your full retirement age benefit is $2,000, filing at 62 drops it to around $1,400 to $1,500. That's a $500 to $600 per month reduction for the rest of your life. It never goes back up. Over 25 years, that's $150,000 in lost income. People justify it by saying, well, I'll collect for more years, so it evens out. The break-even point is around age 78 to 80. If you live past that, and most people do, you lose, badly. But here's what they don't tell you, that early reduction also impacts your spouse's survivor benefit. When you die, your spouse receives the higher of their own benefit or 100% of your benefit. If you reduced your benefit by filing early, their survivor benefit is reduced too. David filing at 62 instead of 70 doesn't just cost him $1,190 per month. It costs Karen that same amount after he dies if she's claiming survivor benefits. If Karen lives another 15 years after David passes, that early filing decision costs their household $255,000 in survivor benefits alone. Most people have no idea how spousal benefits work. Here's the truth. If you're married, you're entitled to the higher of your own benefit based on your work record, or up to 50% of your spouse's full retirement age benefit. Notice I said up to 50%. If you claim a spousal benefit before your own full retirement age, it's reduced. But at full retirement age, you get 50% of your spouse's FRA benefit. Here's the strategy most people miss. Karen's own benefit at 67 is $1,580. David's benefit at 67 is $2,640. Half of David's benefit is $1,820. Since Karen's own benefit, $1,580, is higher than the spousal benefit, $320, she should claim her own benefit, right? Wrong. If David delays his benefit to age 70 to collect the maximum $3,267, and Karen files for her own benefit at 67, $1,580, then when David dies, Karen steps up to David's benefit of $3,267 as a survivor benefit. But if Karen had filed at 62 and taken the reduced benefit of $100 her survivor benefit would still step up to David's amount, but she would have collected $106 for 8 years instead of waiting. The math gets complex fast. This is where people make catastrophic mistakes because they don't understand the interaction between own benefits, spousal benefits, and survivor benefits. Here's something almost nobody checks: your earnings record. Social Security calculates your benefit based on your 35 highest earning years, indexed for inflation. If there's an error in your earnings record, if an employer didn't report your wages correctly, if a name mismatch caused earnings to be credited to the wrong account, if you had self-employment income that wasn't properly recorded, your benefit calculation is wrong. The Social Security Administration estimates that 40% to 50% of earnings records contain at least one error. Most are small, but some are catastrophic. I worked with a retiree whose 2004 earnings weren't reported because her employer went bankrupt and never filed the W-2 data. That single missing year reduced her benefit by $118 per month. Over a 20-year retirement, that's $28,320. She didn't discover it until she requested her detailed earnings record and cross-referenced it with her tax returns. Social Security corrected it, but only because she found it. They don't proactively audit your record. If you were married for at least 10 years and you're currently unmarried, you can claim benefits based on your ex-spouse's work record, even if they've remarried. Even if you haven't spoken to them in 30 years, they don't have to give permission. They don't even have to know. You're entitled to up to 50% of their full retirement age benefit if it's higher than your own benefit. I've seen cases where a woman worked part-time for 15 years, divorced after 22 years of marriage, and had no idea she could claim $1,400 a month based on her ex-husband's record instead of her own $640-month benefit. That's $760 per month she was leaving on the table, $120 per year, simply because nobody told her. If you're angry that this information isn't plastered on every Social Security statement, smash that like button right now. The algorithm needs to push this to every person who's about to file blindly. Hit it. I need to hear from you right now. Drop in the comments. Have you already filed for Social Security? What age? Did anyone explain spousal benefits to you? Have you checked your earnings record for errors? Are you divorced and potentially eligible for benefits on an ex-spouse's record? Your story might be the wake-up call someone else needs. Comment below. Let me show you the framework that can add $1,500 to $1,800 per month to your Social Security income. This is the foundation. For every year you delay filing past your full retirement age, up to age 70, your benefit increases by 8% per year. That's an 8% guaranteed inflation-adjusted return. You will not find that anywhere else in the financial universe. Not in bonds, not in stocks, nowhere. If your full retirement age benefit is $2,500 and you delay from 67 to 70, 3 years, you add 24%. Your benefit becomes $3,100. That's a $600 a month increase. For a married couple where the higher earner delays to 70, this also maximizes the survivor benefit. When the higher earner dies, the surviving spouse gets 100% of that maximized benefit. If David waits until 70 instead of filing at 67, his benefit goes from $2,640 to $3,267. That's $627 more per month. Over 20 years, that's $180 in additional income. And when David dies, Karen continues receiving $3,267 instead of $2,640, adding potentially another $100,000 in survivor benefits over her remaining life. Before you file, request your detailed earnings history. You can do this at SSA.gov by creating a My Social Security account. Download your earnings record. Then pull out your old tax returns or request wage transcripts from the IRS. You can get them for free going back decades. Compare line by line. Look for years with zero earnings when you know you worked. Years where the reported amount is lower than your W-2, self-employment income that's missing, name changes that caused mismatches, especially for women who change names after marriage. If you find an error, you need to file Form SSA 7008, Request for Correction of Earnings Record, and provide proof, W-2s, tax returns, pay stubs. Social Security will investigate and correct it. 1 year of corrected earnings at $50,000 can increase your benefit by $60 to $120 per month, depending on your earnings history. That's $1,340 to $2,880 per year. Over 20 years, that's $2,800 to $57,600. This is the most complex, but potentially the most valuable. For married couples, the strategy depends on the earnings gap. Scenario A, large earnings gap. Higher earner delays to 70, maximizes own benefit plus future survivor benefit. Lower earner files at full retirement age or even 62 if they need income. When higher earner dies, lower earner steps up to the maximized survivor benefit. Scenario B, similar earnings. Both delay to 70 if financially possible, maximizes both benefits and provides flexibility for survivor. Scenario C, divorced. Married 10 plus years, currently unmarried. You can claim on ex-spouse's record at full retirement age, 50% of their FRA benefit. This doesn't reduce their benefit. You can later switch to your own benefit at 70 if it's higher, or switch to survivor benefits if your ex-spouse dies and it's higher. Scenario D, widows and widowers. You can claim a survivor benefit as early as 60, reduced, or wait until full retirement age, 100% of deceased spouse's benefit. Key strategy, claim survivor benefit first, let your own benefit grow to 70, then switch. Or claim your own benefit early, then switch to survivor benefit at full retirement age if it's higher. Optimal strategy. Claim her own reduced retirement benefit at 62, $1,260 a month. Let the survivor benefit grow to 100% at her full retirement age, 67. At 67, switch to the full survivor benefit, $2,600 a month. By claiming her own benefit early and delaying the survivor benefit, she collects $160 a month for 5 years, ages 62 to 167, while the survivor benefit grows. Then she switches. Alternatively, if her own benefit at 70 would exceed the survivor benefit, Claim reduced survivor benefit at 60, a $1,900 month. Let her own benefit grow to age 70, 2,200, 30-month switch to her own benefit at 70. This is called the claim now, claim more later strategy. It's completely legal, but SSA agents rarely explain it unless you specifically ask. Stop. Take a breath. Everything I just showed you is worthless if you don't know your exact numbers, your earnings record, and your optimal filing age. I built a free tool to give you absolute clarity. You'll enter your basic info, age, estimated benefit, marital status, and the system will show you your estimated lifetime benefit under different filing scenarios. Whether you're eligible for spousal or survivor strategies, a checklist to verify your earnings, record, your personalized optimal filing age. It's completely free. It takes 90 seconds. And it could be worth $100,000 to $300,000 in lifetime benefits. Do it right now before you forget. Link is in the description. Let me show you exactly how a real couple can add $800 per month or more using these strategies. Meet James and Patricia. James, age 64, FRA, benefit $3,100, currently plans to file at 67. Patricia, age 63, FRA, benefit $200, currently plans to file at 67. Patricia was previously married for 14 years. Her ex-husband's FRA benefit is $2,900. Their current plan, James files at 67. $300 a month. Patricia files at 67. $200 a month combined. $4,300 a month. Optimized triple stack. Stack number 1, James delays to 70. James benefit increases to $3,144 a month. 24% increase for 3-year delay. Gain, $744 a month. Stack number 2, Patricia claims divorced spousal benefit. Patricia is eligible for 50% of her ex-husband's FRA benefit, $1,150 a month. This is $250 more than her own benefit of $1,200. Gain, $250 a month stack. Number 3, earnings record corrections. James found a missing year from 2005, employer bankruptcy. Adds 115-month Patricia, found underreported self-employment from 2008-2010. Adds 68-month combined gain, 183-month. Total optimization, $744, delayed filing, plus $250, divorced spousal, plus $183, corrections, slapped on 177-month immediate gain. But wait, there's more, the survivor benefit multiplier. When James dies, Patricia will receive 100% of his benefit. Because James delayed to 70, that survivor benefit is $3,144 instead of the $3,100 it would have been if he'd filed at 67. Patricia's survivor benefit, $3,844, versus what she's currently collecting, $150 divorced spousal. $294 a month additional as a survivor. If Patricia lives 12 years after James passes, that optimized survivor benefit is worth an additional $744 a month, x 12 months, x 12 years, or $107,136, compared to if James had filed at 67. Lifetime total additional benefits, $177 a month, while both alive, was still $107,136 in optimized survivor benefits. If James lives 18 years after filing at 70 to age 88, the immediate monthly gains total, 407s, 12x18, $254,232. Add the survivor benefit gain, $107,136. Total household gain, $361,366. That's more than $250,000 in additional Social Security income by understanding and using strategies that are already written into law. Let me show you 3 different retirement couples and how the triple stack changes their outcomes. Couple number 1, single earner household husband, worked 40 years, FRA benefit $2,800, wife, stayed home raising kids, no work record. Traditional approach, both file at 67, husband gets $2,800, wife gets widow, $100, spousal, 50%. Optimized, husband delays to 70, $372, wife files for spousal at 67, when $400. Monthly gain, $670, lifetime gain, assuming husband lives to 86, wife to 90, $197,000 more. Voice, couple number 2, dual high earner household. Both spouses worked full careers. Husband FRA benefit $3,200, wife FRA benefit $2,900. Traditional approach, both file at 67. Optimized, both delay to 70. Husband $3,968, wife $3,596. Monthly gain $464 combined. Lifetime gain $350,000 plus, including survivor benefit optimization. Couple number 3, divorced individual woman, age 66, divorced after 18-year marriage. Own FRA benefit $400 ex-husband's FRA benefit, $3,600. He's now 68 and already filed. Traditional approach, files for own benefit at 67, gets $1,400 optimized. Files for divorced spousal benefit, 50% of ex's FRA, and Ross at 1-800. Monthly gain, $400, 20-year gain, $96,000. The pattern is clear. The less you know, the more you lose. Here's something most people forget. Some states tax Social Security benefits. As of 2026, 9 states tax Social Security to some degree. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, West Virginia. Note, this list changes frequently as states adjust policy. If you live in one of these states, your filing strategy should account for state tax impact. Example, in Minnesota, if your provisional income exceeds certain thresholds, up to 85% of your Social Security becomes taxable at the state level, in addition to federal. Strategy adjustment. You might want to do Roth conversions in early retirement before filing for Social Security to reduce your taxable IRA balance. This keeps your provisional income lower after you start benefits, reducing the tax hit. In states with no income tax, Florida, Texas, Nevada, Tennessee, Washington, Alaska, Wyoming, South Dakota, New Hampshire, this isn't a concern. If you live in a state that taxes benefits, run the numbers with a CPA before finalizing your filing strategy. The optimal age might shift by a year or two depending on tax impact. Here's your step-by-step action plan. Step 1. Create your My Social Security account at ssa.gov. Verify your earnings record. Download your Social Security statement. Check your estimated benefits at 62, FRA, and 70. Step 2. Request your IRS wage and income transcripts. Go to irs.gov and request transcripts for all years you worked. Compare them line by line with your SSA earnings record. Document any discrepancies. Step 3. File corrections if needed. Submit Form SSA 7008 with supporting documents, W-2s, tax returns. Follow up every 30 days until resolved. Get confirmation in writing. Step 4. Run optimization scenarios. Use software like Maximize My Social Security Solutions, or SSA's own calculators. Model different filing ages for you and your spouse. Include survivor benefit planning, factor in life expectancy and health status. Step 5. Check for auxiliary benefits. Divorced spouse benefits, if married 10 plus years, currently unmarried. Survivor benefits, if widowed. Dependent benefits, children under 18 or disabled adult children. Step 6. Decide your filing strategy. Set your target filing age. Calendar the date. Prepare to file online or in person. Step 7. Monitor for changes. Social Security law can change. If Congress passes reforms, reassess your strategy. Review annually until you file. Save this video. This is your Social Security survival guide. Let me address the 3 objections I hear constantly. Objection number 1, I might not live to 80. I should take it early. I understand the fear, but statistically, if you're healthy at 65, men have a 50% chance of living to 85. Women have a 50% chance of living to 87. One member of a married couple has a 50% chance of living to 92. If you're in average health, delaying is the mathematically superior choice, and even if you die early, your surviving spouse benefits from your higher benefit, or you can take action right now. Take the free Social Security Optimization Assessment, get your personalized filing strategy, verify your earnings record, and claim every dollar you're legally owed. Do it today, not next week, not next month. Today. And if this video just saved you $100,000 or more in lifetime benefits, share it with one person who's about to turn 62 or who's already filed but doesn't know about survivor benefit switches or earnings record corrections. One share could change someone's entire retirement. That's not hype. That's math. Hit share. Hit subscribe. Turn on notifications. I'm Jordan, and I'll see you in the next breakdown here on Jordan Retires. Don't let the system win. Get your money.